4.13%. That is what the U.S. 10-year Treasury is yielding right now, and gold is at $5,171. At the same time, in the same market. If you have been following precious metals for any length of time, you know those two numbers are not supposed to coexist. A 4% Treasury yield is supposed to pull money out of gold into bonds. That is the textbook. That is the relationship that has held for decades. And right now, this weekend, it is breaking down in real time. What that breakdown means for Monday's open, and for your portfolio, is exactly what this video is about. Last week, I told you to watch silver's behavior relative to the gold-silver ratio as a leading indicator of which metal was likely to move first in the next leg. I said if the ratio started compressing, if silver began closing the gap on gold in percentage terms, that would be a structural signal worth taking seriously. Pull up the ratio right now. It is compressing. Silver is sitting at $85, and the relationship between these two metals is shifting in a way I have not seen in a while. That call is developing exactly as the data suggested it might. I want to be precise about what that means and what it does not mean, and we are going to get into that detail in this video. My name is John. I left 15 years in currency and commodity markets because I watched too many retail investors get handed the wrong framework at exactly the wrong moment. That is why Currency Insider exists. Everything I show you today comes from publicly available data, and I will name every source as we go. 3 things you're going to understand by the end of this video. First, why gold rising alongside a 4% Treasury yield is not just unusual, it is historically significant, and what it tells us about what is actually driving this market. Second, what a Monday gap opening means mechanically, and how to think about it without letting the emotion of a weekend news cycle make your decisions for you. Third, the one specific level I am watching at Monday's open, and exactly what I will do with the information when I see it. If that kind of grounded, data-first analysis is what you have been looking for in this space, hit the like button right now. It tells me to keep making these. And if you are not subscribed, this video is part of a weekly sequence and the context compounds. Now is the time. Let me give you the price picture so we are all working from the same data. Gold closed the week at $5,171.12. Silver closed at $85 flat. The DXY, the US dollar index, is sitting at 98.99. The 10-year Treasury yield is at 4.13%. Oil is pushing $90 a barrel. And the Middle East conflict that began escalating just over a week ago is now in its 7th day, with no resolution in sight and reports of oil production adjustments coming out of Kuwait. Now here is why that cluster of numbers matters together. In a normal macro environment, you would expect at least one of these to be acting as a pressure release valve on gold. A strong dollar should be headwind. A 4% Treasury yield, which means investors can get a real, guaranteed return in dollars, should be pulling capital away from a non-yielding asset like gold. Oil at $90 with a stagflationary undertone should be rattling risk sentiment in a way that creates volatility across all commodities. And yet gold is not just holding. It held at 5,171 going into a weekend where the geopolitical situation could move in any direction before Monday's bell. That tells you something important about the nature of this particular bid. This is not a dollar weakness trade. This is not a rate expectations trade. This is a genuine flight to safety, the kind that happens when investors are not adjusting a portfolio. They are protecting one. Now I want to talk about why the Treasury yield relationship is the most important thing to understand here, because this is where most of the confusion in the market right now lives. The standard model says gold and real yields move inversely. When yields rise, the opportunity cost of holding gold, which pays no interest, increases. Rational capital flows to bonds. Gold suffers. That model has been broadly correct for most of the last 30 years. So what happens when it breaks? In 15 years of watching these markets, I have seen this specific relationship fail in one consistent set of conditions. Not during recessions. Not during normal inflation. It fails when investors stop trusting the instrument that is supposed to compete with gold. Think about that carefully. If you hold a 10-year Treasury at 4%, and you genuinely believe the U.S. fiscal trajectory is manageable, the dollar is stable, and the geopolitical environment is contained, that 4% looks attractive compared to gold at 0 yield. But if any one of those assumptions starts to crack, fiscal math, dollar credibility, or geopolitical stability, the Treasury yield stops being a ceiling on gold. It becomes irrelevant to the gold buyer's decision. Right now, all 3 of those assumptions are under pressure simultaneously. The Congressional Budget Office has documented the U.S. fiscal deficit trajectory in terms that are increasingly difficult to describe as manageable. The dollar at 99 DXY is not collapsing, but it is not the unquestioned reserve currency of 10 years ago either. And the geopolitical situation in the Middle East, 7 days in, oil approaching $90 with a Strait of Hormuz risk premium building in energy markets, is exactly the kind of environment where institutional money makes a decision that is not about yield. It is about what survives if the situation deteriorates. That is why 5,171 and 4.13% coexist right now. The Treasury yield is not winning the argument. If you know someone who has been confused about why gold keeps climbing in a high-yield environment, share this video with them right now. That question is exactly what this video exists to answer, and the people asking it are probably not finding this kind of breakdown anywhere else. Let me talk about the gap risk specifically, because this is the mechanism that catches retail investors off guard most consistently, and I want to make sure you understand exactly how it works before Monday's open. A gap occurs when a market opens at a price meaningfully different from where it closed. In gold futures, which trade nearly continuously, a true gap is less common than in equity markets, but what we can see is a sharp directional move at the Sunday evening open when institutional players reprice the asset based on whatever happened over the 48 hours the market was effectively closed for retail participants. This weekend has accumulated 2 full days of geopolitical news. Whatever develops in the Middle East between Saturday morning and Sunday evening's futures open goes directly into the price in the first minutes of trading. No gradual absorption, no time to think. The market just moves. Now here's the thing I want you to take from this. A gap upward through 5,171 is a signal, not an instruction. It tells you that institutional money repriced gold higher based on new information. It does not tell you whether that repricing is correct, sustainable, or the beginning of a larger move. Think of it like a thermometer rather than a thermostat. The gap tells you the temperature of the market's fear at that specific moment. Your job as a serious investor is to read that temperature without letting it make your decisions for you. The article I am working from this week identifies 5,400 as the next significant resistance zone above 5,171. That is a documented technical level, and it is worth knowing. But between here and there is not a straight line. There are institutional players who have been long since 5,000 or lower who will use any gap up as an opportunity to take partial profit. That selling into strength is what creates the choppiness above a gap. Understanding that in advance means you watch the price action with context rather than emotion. I want to pause here for a moment and ask you something I genuinely want to know. Drop this in the comments right now. 2 things. First, are you currently holding gold, silver, or both going into this Monday open? And second, when you saw gold at 5,171 with a 4% yield, did your instinct say that is wrong and unsustainable, or did it tell you that the model has changed? I read every single comment, and right now the section below this video is a real-time sentiment tracker for serious precious metals investors. The geopolitical layer here is not background noise, it is the primary driver, and I want to be precise about it without either dismissing it or catastrophizing it, because both of those failure modes are common in this space. The Middle East situation entering its 7th day of escalation matters to precious metals investors for one specific mechanical reason beyond general fear. The Strait of Hormuz. Roughly 20% of the world's oil supply transits through that strait. When there is credible risk, not certainty, risk, that the strait becomes contested, the oil market prices in a premium. Oil at $90 with that risk premium baked in creates a stagflationary input cost shock. Higher energy costs, supply chain pressure, without the economic growth to absorb them. Stagflation is one of the most historically reliable environments for gold because it exposes the weakness in both equities. Growth gets squeezed, and bonds. Inflation erodes real yield. The World Gold Council's documented data across multiple stagflationary periods shows gold outperforming both asset classes. I am not saying we are in full stagflation. I am saying the inputs that have historically produced that environment are assembling in the same place at the same time. Now here is the honest caveat, and I think this is important. Geopolitical risk premiums are the most volatile and reversible of all the drivers we track. One credible ceasefire announcement, one diplomatic breakthrough, one de-escalation signal from a key actor, and the fear premium unwinds fast, faster often than it built. The bearish scenario in a geopolitical-driven gold market is not fundamentally wrong gold. It is geopolitics resolving faster than the market expected. That is a very different risk than a structural bear case, and it is worth keeping that distinction clear in your mind. For UK investors specifically, the LBMA published data showing London vaulted gold flows have been notably active in recent weeks. London is the world's largest over-the-counter gold market, and when LBMA vault activity picks up alongside geopolitical stress, it often reflects institutional allocation decisions that precede the retail narrative by days or weeks. That is a signal worth watching alongside the COMEX data. And here is where the silver story intersects with everything I have just said about gold. Because while gold is the headline, silver at $85 with a compressing gold-silver ratio is the part of this picture that I think is being underappreciated right now. The Silver Institute's most recent published data shows silver in a structural physical deficit, consumption outpacing mine supply and recycling for the third consecutive year. Industrial demand from solar manufacturing, EV components, and AI hardware infrastructure is absorbing physical silver at a rate that has not historically coexisted with a suppressed price for long. Silver is not like oil where you can watch it burning. It is dispersed invisibly into billions of products, solar cells, circuit boards, medical instruments, in quantities so small per unit that even a sharp price move does not immediately trigger substitution. The demand is sticky. What the compressing gold-silver ratio tells you is that the institutional bid is beginning to notice. When gold moves on fear, silver often lags, initially, but if the fundamental supply picture is as tight as the Silver Institute data suggests, a sustained gold rally creates the conditions for silver to close the gap in percentage terms with unusual speed. I am not going to give you a silver price target because that would be false precision, and you deserve better than that. What I can tell you is the direction of the pressure, and right now it is pointing in one direction. That direction has not reversed. All right, let me show you how I am actually thinking about this week using the 3 lanes framework. This is how I separate what is noise from what actually matters. Lane 1 is the paper market. Gold futures heading into Monday carry an extreme gap risk designation. That is not my language. That is the market's behavior reflected in the weekend positioning data. The 48-hour geopolitical accumulation window means the Sunday evening open is the first real price signal we get. Watch the open, watch the volume in the first 30 minutes, and watch whether 5,171 holds as support or gets rejected as the first trade of the week. Lane 2 is the physical market. Silver at 85 with a compressing ratio. COMEX silver registered inventory that has been draining for months as I covered in last week's video. LBMA vault flow activity elevated. The physical lane is not telling a quiet story right now. It is telling a story of sustained institutional accumulation that has been building quietly while the headline focus stayed on gold. Lane 3 is macro, DXY at 98.99, dollar strong but not dominant. 10-year Treasury yield at 4.13%, normally a gold headwind, currently losing that argument. Oil at $90 with a geopolitical risk premium that could expand or contract before Monday's open. In 15 years watching currency and commodity markets, the times I have seen all 3 lanes point the same direction simultaneously, paper market stress, physical market tightness, and macro drivers aligned, have been some of the most significant inflection points I have witnessed in these markets. I am not saying we are definitively at one of those moments right now. I am saying the configuration looks more like those moments than it looks like anything else I have seen recently. When all 3 lanes are in alignment and you are sitting at home holding metal, that is not the moment to react. That is the moment to have already decided what your framework is. A framework, not a forecast. You decide what to do with it. Here's the one thing I am personally watching this week. One thing. The Sunday evening futures open for gold. Specifically, whether the first traded price is above, at, or below 5,171. That single data point will tell me more about how institutional money assessed the weekend's geopolitical developments than any news headline will. If gold opens above 5,171 and holds it through the first 30 minutes of trading, that is confirmation that the institutional bid is real and the safe haven demand is not retreating. If gold opens above 5,171 but immediately sells back through it, that tells me the gap was noise, a reactive overshoot that got faded by profit takers. And if gold opens below 5,171, that tells me the weekend brought enough de-escalation signal to unwind a portion of the fear premium. 3 different outcomes. 3 different sets of implications, all of them readable from a single price level at a single moment in time. I will name what I see next video before I say anything else. This is my one call for the week. John, FX Insider, on record. I will be back next video to tell you exactly what happened. No edits, no excuses. That is the only way this works. Now here is where I want to be completely straight with you, because this is where most channels pick a side and run with it. I am not doing that. Here is what needs to happen for the optimistic picture to develop. The Middle East situation needs to remain unresolved or escalate through the weekend. Oil needs to hold above $85 per barrel heading into Monday, and the institutional positioning that has been building in gold needs to express itself in the form of a clean gap higher that holds on follow-through volume. If those conditions align, the 5,300 to 5,400 zone becomes a live scenario in the near term. Not a guarantee, a live scenario. Here is what needs to happen for the cautious picture instead. De-escalation news, a ceasefire, a diplomatic signal, a pullback in oil, arrives before Sunday evening's futures open, and the fear premium unwinds. In that scenario, gold does not fall because something is fundamentally wrong with the gold thesis. It falls because one specific driver, geopolitical fear, got removed temporarily. The distinction matters enormously for how you interpret the move. A gold dip on de-escalation news is not a structural bear case. It is a fear premium compression. The underlying fiscal pressure, the Treasury yield credibility question, the physical silver supply dynamic, none of those resolve because a ceasefire was announced. Both outcomes are genuinely possible this weekend. Your job is not to pick one and emotionally commit to it before Monday's open. Your job is to know what each price action signal means when you see it. The market will tell you, you just have to be watching the right things when it does. Before we close, the disclaimer you need to hear, and I mean it. Everything in this video is educational content based on publicly available information. Currency Insider does not provide financial advice, investment advice, tax advice, or legal advice. Nothing here should be construed as a recommendation to buy, sell, or hold any asset. Past market behavior is not a guarantee of future results. Always consult a qualified financial professional before making investment decisions. Before the two questions, if you got value from this today, the like button takes 1 second and it genuinely helps this channel reach the investors who are navigating this market without the noise. Hit it now. I want to ask you two things and I genuinely want your answers, not just a thumbs up. First, going into Monday's open, are you holding your current position as is, or have you made any adjustments to your gold or silver exposure this weekend based on the geopolitical situation? Tell me what you did and why. Second, the gold Treasury yield relationship breaking down. Do you think this is a temporary dislocation that snaps back once the geopolitical situation resolves? Or do you think something more structural has shifted in how institutional money thinks about gold versus bonds? Drop both answers below. The comment section here becomes a real-time sentiment tracker, and I read every single one. Subscribe because next week, whatever happens at Monday's open, I am coming back to that 5,171 level with the actual price action in hand. We are going to go through exactly what happened, why, and what the move tells us about the next setup. That is analysis worth having before the week gets away from you. And if someone in your life is watching their stack this weekend and trying to make sense of why gold is doing what it is doing, share this with them. That is the whole point of this channel. This is Currency Insider. Know the market. Protect your currency.